Hello, this is Jed Brewer with Study Groups in the Below the Line Club. It's very nice to have you on our webinar today as we talk about credit and collections, especially as it relates to what we are doing during COVID-19. Very pleased to have 4 panelists on the call today. The first 2 are study group members with Sampson Bladen Oil Company out of North Carolina. Sampson Bladen is a full-line petroleum marketer / convenience retailer. They operate about 80 Andy Hugo convenience stores in North Carolina. Also have a transportation company, commercial fuels company, lubricants company, dealer business. So kind of touch many different aspects, and I'm sure there's other businesses that I haven't mentioned as well. But we'll have Howell Clark, who's a co-owner of Sampson Bladen, and Jeff Smith, who is the CFO of Sampson Bladen. Both of them sharing a little bit about what they're doing on the credit and collection side as our world is changing somewhat due to COVID-19. We'll follow that with Ann Pitts, who's owner of the Pitts Group out of Texas. And Ann is a consultant to the industry and really specializes her whole career on credit and collections and works individually with firms one-on-one. Ann will share some of her tips and tricks that she recommends for us on the credit and collection side. And then lastly, we'll have Corey Watson, who's president of Lycle Insurance out of Texas. Lycle Insurance is a credit insurance company. And one of the questions that I know many of us have is what options do we have available with some of our customers as their risk profile has changed? Is credit insurance still available? What kind of trends are we seeing in the credit insurance market as one potential tool in our toolkit that we plan to talk about here today? So Corey will touch on that at the end. I have everybody on mute. But we want to make this as engaging and conversational as we can and answer any questions that you have. So if you do have a question, please type that into the GoToWebinar dialog box. I will be able to read those questions, and I'll try to relay them at the appropriate time as best we can to each of the respective panelists or presenters. There's going to be a couple slide decks a little bit later when Ann and Corey share more. And Corey and Ann have been very kind to allow us to share those slide decks with you afterwards. So we'll send that out to you. We'll also be recording this webinar, and so we will get that recording to you as well, should you want to share it with a colleague or view it again. So on that note, let's go ahead and jump right into credit and collections and start with Howell Clark and Jeff Smith of Sampson Bladen. So if we break down credit and collections, it's really 2 pieces. One is the credit side. The other is, all right, we've approved somebody, we've made the sale, and now we need to collect it. So let's start on the credit side. And Hal and Jeff, just ask you, are there specific credit policies you've done or procedures that you've had in place that are serving you well during this time?
Yeah, Jen, it's Howell. There are. We learned a pretty hard lesson in 2010 that showed us that our policies were not adequate, and it is an expensive lesson. So we revamped our complete credit policies and documents then to include additional security on dealer accounts. And since that period, we review the policies and documents and credit limits monthly, change and modify them when necessary. We review AR weekly, and we push AR out to the salespeople weekly. And then around 2016 or 17, when we started making a push into the commercial and industrial markets, we added AR insurance to our toolkit. And so I feel like that coming into this thing, that we had a really good handle on the credit limits that we had established, and we did a good job of keeping up with them and monitoring them on wholesale fuels and past dues, typically less than 1% of monthly sales volumes. Lubricants are a little different, longer terms, and now everybody's on EFT. So that usually runs 2 to 4% of monthly sales volume. So I think we came into this in a real good position. But in my opinion, anyway, aside from the erosion of our top line and the associated decrease in cash, a big AR default poses one of the biggest threats to us right now. So what we've done is we've not modified any policies, except that now the AR comes out daily instead of weekly. And that's the first thing I do every morning is I look at it and I call each one of the business unit managers, and I go over it with them and with collections or credit if we need to. So it's really a focus every single day. And another thing that we did is we tightened up some things, particularly in lubes, where you'd send a lube driver out in the morning to run a keep full route, and by the time he got back in, he had put a couple of customers over their credit limit. We're really focused on that and calling ahead and getting payments in from those guys that's going to put them over their credit limit. And we've quit delivering anybody that's past due. Everybody's got Joe who always pays. He's just a little slow. Well, Joe's got to pay now before he gets another delivery. And other than that, just having people focus on the credit and the AR.
So are you doing like I heard you say you do daily, you personally, a review of the AR. Are you doing team conference calls or anything like that so everybody's on the same page?
Yes, the report generates at 8 a.m. every morning, current through what was posted last night, and I call every business unit director, manager every morning before 9 o'clock. I have a conversation with every one of them on the wholesale side, which is what I'm responsible for. And also, if there's questions, we bring credit in as well. And we're probably right now averaging once a week on having that conversation with salespeople. But yes, I review it with the business unit managers every single morning. First thing I do.
And another thing I heard you say is if you have a customer who is past due, no new deliveries to that person. How is the customer receive that message?
Well, as you would expect, some will understand, some of them get upset, but I've got to protect my business, and that's and really that was the policy beforehand. It just was not strictly enforced, and that's primarily on the lubricant side. With the dealers and the commercial fuels, all the dealers are on EFT, and the majority of customer fuels, commercial fuels, are either EFT or ACH. So that's really on the lubricant side.
And on the AR collection side, are you increasing your bad debt reserves at all in preparation for potential customers that may not be able to pay?
That's on Jeff. Yeah. Jed, we have
I'm the CFO.
we are monitoring our we are monitoring our bad debt reserves. We have not proactively increased our credit reserves, our bad debt reserves. We don't, because of the work that Howell and the business unit guys and the sales teams are doing to proactively pursue these accounts. I don't see any erosion at this point, and so therefore I have not gone in and adjusted that. We have maintained our bad debt credit reserve at what we were formerly doing, around those percentage points that Howell mentioned at the top of his points, but we have not gone in and adjusted them up at this time.
Mm-hmm. And then a question from the audience, which is just a general to put in context sort of the conversation, but the question is, how many credit people do you have working and, roughly accounts?
We have one credit manager that oversees the lubricant accounts and helps with the administration of the dealer accounts. I work very closely with that person in the decision process, and but that role is really towards gathering the data, putting together the information, and then as a team, we go through and look at what the limits are. While you have a title there for that role and some of those administrative tasks, to Howell's point, it's really a group effort, especially now where we are tying in not only Howell's influence in making sure that this is top of mind, but also the business unit managers and sales folks to make sure that we're all looking at this together. So yes, we only have one specific credit manager, but we are looking at it as a group team function.
Well, and you also got Jody too. So really, you got two people, one looking at lubes every single day, and then one that's kind of the credit manager over the fuel and the lubes. With regard to number of accounts between dealers and wholesale fuels, somewhere, Jeff, 175 or 200.
Active in that regard, yes. Yeah.
And how about on lubricants?
I would say that's more in the 700 range.
Yeah, I don't have that number in my head right now, but.
Are you guys seeing any customers that are asking for term extensions? And if so, how are you handling these requests?
Hal, I'll jump in on that. We have, in this time, we've only had one dealer came to us and asked us for a delayed draft, and one other dealer is also a tenant has asked us for a delay in rent. Now, in both of those, what we do is we have a delayed draft policy that goes out with our initial applications and contracts, and so they know about it well in advance. They actually have to sign this paper when we do it. First request for a delayed draft is a $50 fee. Second request for a delayed draft, $100 fee. Third request, $150. It means all this, we could, they know about it. So we haven't had many. We've only had the one, and then in the conversation with the dealer was, well, tell me about, your margins at this moment. In the past 2 or 3 weeks, we know that their margins have been fairly good. So after the conversation, that kind of fizzled out.
Well, and early in the process, Jeff sent info to all of our dealers and commercial customers outlining the SBA Paycheck Protection Program, and offered to help them apply, figure it out if they needed to. And we're encouraging to seek those funds from the bank and reminding them that, we're not the bank. And several of them have taken advantage of it. They're very grateful that we pointed it out to them. So we're really steering them away and hoping that we don't get a lot of those requests right now, because they do have good margin.
Absolutely. And one thing I heard a different study group member say is it's important to identify the customers who can't pay versus those who won't pay. And you can work with the people who can't pay, but if somebody just won't pay and they're able, then you got to really say, boy, do I want to continue to do business with this person?
Well, I think that's a process that we look at all the time.
Yeah, absolutely. A question on your bad debt reserve, as best practice, Jeff, what percent of sales are you reserving as bad debt? Do you have a feel for that rough number?
Well, as a percent of sales for the wholesale side is it's hard to do because of the way the price of fuel goes up and down. But we've got let's see, we've got about 1% of monthly sales volume in past due AR for dealers, and then a smaller percentage of that which we actually put in bad debt would reserve for. So the dealer side of it, I look more towards the accounts and estimate what we have out there and look at a certain account. If they have a $200,000 credit limit and I've got, 100 of those, then, I've got to look at that part of it. And I don't have an exact percentage of sales, but that's how I look at it. On the lubricant side, it's generally we're looking at about 2%, because that's a little bit higher, and we've got many more customers there to follow up with.
So what you're saying is that you don't really base it on cost of sales, you base it on exposure.
Right.
That makes sense. And across the board, I don't know if you said this exactly, have you made any reduction in terms, say, for your dealer business, everybody used to pay at 10 days, but we're going to reduce that to 7, just as an example, or under lube business, just across the board reduction in payment terms, or is everything sort of status quo of what it used to be?
We have not gone through and done that across the board. To Hal's point, we did keep our some of our lube accounts that were, if they're net 30 and they're paying net 35, it's like, well, wait a minute, guys, we got to tighten this back up. Time to get to 30. Just keeping them within our current policies.
And as this whole COVID-19 situation happened, was there anything new that occurred that either displayed vulnerabilities that you had in your company? Any key learnings that you've had on the credit or collection side as related to COVID-19?
From my perspective, which is more operational, with a lot of our customers, particularly our dealers, they're not necessarily the best money managers. And so, we've discussed that with them, that they're making good margins now. They need to put some back because it's going to turn around, and margins are going to get tight again. We're encouraging them that they can explain it to them that, hey, you can take a split load. You don't need all this inventory because your demand's way down. Your margins will cover the split fee. And when that EFT comes due, you should have sold enough of that product that between cash and credit cards, it's no problem. You're not having to come out of your pocket with cash. Jeff may have some more input on that on his side.
Where I think our exposure is going to come in, and the thing that we need to help prepare our dealers and wholesale account for, is when the fuel market does go back up, and it can go up almost as quickly as it came down, and their cash flow is going to get pinched very tightly, as could be expected. So that's the part of it the things that Howell just talked about letting them know beforehand, we may need to work with them. That will help us on that side of the market shift.
Mm-hmm. And then we talked briefly about customers who can't pay versus customers who won't pay. Won't pay customers, we've got to really either reduce their terms or not do business with them. But on the can't pay customers, have you had any of those people yet? Maybe it's a company who's been decimated by COVID-19. Could be a limousine company, for instance, who their volume just gone away, but they don't have the cash flow to pay any AR that they've had back. Have you had to address that yet, and any strategies that you've used?
We have not had to address that at this point.
Fortunately, we have not. You're right, Hal. We've only had the one request for delayed draft. That was by a branded dealer, so that was not that kind of went away. but we've had no other commercial accounts that have frozen up. I mean, we've had those in the past, but that was all prior to the current pandemic that we've had to deal with. We have not seen any recently. Thank goodness.
Mm-hmm. So before we turn to Ann, and I think Ann may address that question a little bit of some strategies about somebody who just can't pay and what we should do. But any key takeaways or last comments that you guys want to make? We can circle back with Q&A, but something you wanted to share that we haven't addressed yet.
Well, one challenge that we're encountering is that with so many people working remotely, it's often difficult to resolve any billing issues. So we've been real proactive, and we got our folks looking and paying particular attention to the billing to identify and address any billing issues earlier in the process to prevent that from becoming a cause or an excuse for a balance going past due. Because when everybody was sitting in the same office, you made a phone call, you know, they walked across the office or talked to somebody. Now sometimes that's taking a half a day to get information back if there's a billing discrepancy or a BOL discrepancy. So we're just trying to stay proactive on that so that we remove any opportunity for the customer to say, this is why I'm not paying you.
Well, thank you, Hal. Thank you,
Yeah,
Jeff,
there's
for your
one other
candidness.
comment.
Go ahead, Jeff.
I did want, for the role that I hold, and you think about accounts receivable, and if you, we are fortunate that we have our loans with our bank are collateralized primarily by real estate, but I got to thinking about this. Anybody that has asset-based lending, borrowing base can get out of whack very quickly if your accounts receivable is getting, your customers are getting past due, if your working capital ratios are not keeping very much in tune, that can get out of whack, and then your bankers start looking at you sideways. So that's why I'm just real excited to be a part of this and what Ann and Corey had to say, because that will help keep that side of accounts receivable from hurting your business.
That's good input, good advice. Ann, let's turn to you and allow you to share a little bit of some tips and tricks as it relates to credit and collections, expanding on what we heard Howell and Jeff say.
Okay, Jed, thanks for having me again. It's good to be with your group. I was with the webinar 2 weeks ago talking about strategies to protect your company's cash, more on the front end of the accounts receivable action plan. And so today I'm going to talk about what I consider the back end of the funnel, which is getting paid. And I'm just going to tell you guys, my husband laughingly says I'm a cheerful pessimist. So I'm going to take a viewpoint and give some advice as this thing grinds on. Let's say we're still grinding on through this, you know, everyone's staying at home for the next month, which I think as a person, you know, it certainly could happen. But so I'm going to look into the future and give you some things that might be strategies as you might need some different things to be doing. In the description, Jed, of the webinar, we put in there how to ensure you will get paid for the delivered product. And that's a really bold claim, but I'm just going to say I think it's going to take a different kind of effort than it has in the past. And I believe that getting paid is going to require, I loved what Hal and Jeff were talking about, where the management, the ownership, it's on their focus, it's on their radar screen every day. It takes a lot of communication internally, but I think it's going to require a whole lot more communication externally with your potentially distressed customers. So you see where we are right now. Sales are still there, maybe even up in some cases. But I think it's time to get really proactive and get on the front end of how to figure out what customers are likely going to be having problems and having problems getting you paid in this time of economic disruption. And what is as important is, what is your reaction going to be? So how are you going to handle and work with people that are probably good customers, have been stellar customers, but in the next few weeks might be having problems? So thanks, Jed, for going to that slide. So your AR aging and credit department's reaction, to who lands outside of the current column is going to look different for not just, like I said, if this is grinding on to the end of May, but there's going to be months after that we're still going to be sorting things out. So how do you run your business? Well, I think you have to think about what is your objective beyond just getting paid? What is your company culture going to dictate? Are you going to be able to help customers weather their own storms? Are you going to cut them off right at the get-go? Who deserves what? You know, you probably aren't going to be able to treat everybody the same. That's a different collection effort, like I said earlier. And it's going to be different for all of you, you know, based on your management level decisions and based on your industry segments. But as far as just having your collection person calling around reminding customers that they have invoices due, I don't think that's going to work that well. I think it's going to take a higher level of planning. So I want to remind everybody, and Hal alluded to this earlier, that a basic rule of thumb in lending, it needs to be a line in the sand, in my opinion, is that you want to get paid when your customer resells that product and he gets paid, or uses the product to create something that creates revenue for them. So that's your guys, your customers turning your product into cash. They should be paying you as agreed. If they aren't paying you, they are using your cash to run their potentially stressed business. You know, the example that Hal talked about, you know, dealers, if they're reselling your fuel, they need to pay you. You look at the flip side of oil change business that bought oil, but they're not servicing customers, they're going to have problems getting that done. So I think go to the next slide, Jed, and so what I'm suggesting is that you need a diagnostic framework to determine who's impacted, what business segments are probably okay, and what segments are not. Most of you guys use back office systems that have this capacity to classify by SIC code, by business segments. You know, I hate talking about the 80-20 rule, but I'm just going to say, you know, you classifying the top volume and dollar customers into this kind of a diagnostic framework would be a good way to develop an action plan. I would say that you would really focus on that those 20% top guys, maybe the guys that are sitting in that hard stop column, certainly, maybe a lot of them that are sitting in the slowdown, and you get on the phone with them. You get on the phone to hear their story. The other customer segments, that's a bunch, 80%'s a bunch, but it could be more of an automated effort, at least in the beginning, with dunning letters, with emails, touching them, you know, to get the conversation started. So I want to challenge you guys to look at your book of business in the near future, kind of like a third party would come in and look at it. You know, don't let previous impressions of customer behavior or even strength affect this diagnostic analysis, because this is a whole new world with a different landscape. So, you know, I'm just going to share from my work. I think a lot of lubricant-focused distributors think that the fuel distribution segment carries more risk, and it probably does. It flows faster and bigger gallons and goes out the door quicker. But at this juncture, I'm not sure that the lubricant business isn't going to be every bit as impacted when you think about the extended terms, 30-day terms, and interruption of certain business segments. I think it's going to create a tough landscape. So I want to encourage you guys to look with a totally new eye. Next, what is the methodology to implement these solutions? You know, who's responsible in your business? Who has authority? What authority does the staff have? Who's on the phone getting the various stories? Who's calling the customer? Who's calling on customers in person? So it needs to be a collective effort. And so my next slide here that Jed went to, I want to talk about excellent collection processes. And they really need to be in place, including having a script of what your collectors need to learn when they get a customer on the phone. I really don't care how seasoned the collector is. A script with bullet points is very helpful, because they're going to be having different conversations, potentially more stressful conversations. They will miss things. They will forget to ask things. Obviously, you can, you know, how are things going? You know, in the business, how's the business being impacted, there are invoices due, how are those going to be handled, and you don't ever want to end the call, without a call to action. What is the next step with a deadline? We're in a changing landscape here, so good collectors, they usually start their day calling early. Seems like you reach more people early in the day. Jed, I didn't remember doing an animation, but I think if you click, you're going to see some more bullet points on this slide, and maybe one more. So good collectors, okay, thank you. Good collectors block out time to make calls. They don't just make a few calls, answer a few emails, have interruptions, with employees. Maybe they're working from home. I'd like to see it blocked out in 1.5 hour chunks where they do nothing but work that phone. Then they get up and they catch up with some other things and they break it up a little bit. As they make these calls, they need to be clearly documenting discussions in your CRM system and setting ticklers, not sticky notes, but actual computer ticklers to record customer promises. The customer promises and keeping up with those promises is going to be really, really important. They also need to keep you guys, management, and sales well informed on what they're learning, because they're actually doing an investigative, forensic kind of action now besides just calling and reminding people invoices are due. It could be possible that your credit department is not staffed up to handle this kind of investigation and game plan negotiation. So you might want to take a look at who could be redeployed from their normal company duties for this really important project. It's not going to be from now on, but it's an important project of getting a clear picture on what's going on with your customer base. You're truly acting as their business partner at this point when you're finding out where they are. The customer service folks can potentially fill this need. It could be even some, other management level operations people that are really good at what they do and know the customer base that could fill in some of this. If you want to hire some staff to make these phone calls, I bet there are a lot of out of work folks in your communities that you could bring in at a contract basis, arm them with a good tight script, and let them do some of this due diligence work. Okay, so now you're talking to customers, you're getting a feel for their situation. Next, what's the objective for the customers that are going to have trouble paying you, but you want to keep them as a customer, keep them rolling, partner with them through this period of time. And it is a period of time, guys. Even a cheerful pessimist will agree that this is not going to be the normal from here on out. So you're going to have to think about workouts. And I want to just discuss a couple options for workouts. Number one, you're going to have to create a workout situation that works for them. It can't just be for you, because if they promise to do something they can't do, you're not any better off. So what can they do? Can they make smaller, more frequent payments on their invoices? Hal talked about dealer with a split load. There's workout things that you just have to think real creatively. Can you take a block of that debt, set it aside in a notes receivable with scheduled payments over a period of time? Maybe you don't even start the payments for 6 months. You're going to think about your credit card acceptance strategies. I think it's been kind of a good practice to stay away from that as much as you can, but it's this landscape. Accepting credit card payments might be a way for you to get paid and give people some healing time, for them to get their feet back under them as time goes by. Think about collateral, real estate, rolling stock. Some guys might be able to get you a letter of credit from their bank. There's payment bonds that can be bought from insurance companies, personal guarantee. There's just a lot of options in collateral. So what it basically comes down to is, what does your customer have that's valuable to them and that you could turn into cash? And so, you think about workouts. I know what you're thinking. You're sitting there thinking, boy, this is going to hit my bottom line. And yeah, it is. But this is just a unique time. We're going to have to get through it. It's better to get potentially something than to get nothing. So all of these things I would suggest need to be discussed with staff ahead of making these calls or visits with levels of authority established. It's important to give your staff authority so that in the moment they can make every contact count with a customer promise and a negotiated solution agreement in the moment. Okay, Jed, I'm going to go to my next slide. I want to just hit on the fact that with all this going on in the next month, communication is key between customer and management. So it needs to be crystal clear how these investigative efforts are shaking out so that you guys, so that Jeff Smith's over there can see the trends developing for operational cash. You know, evaluation standards need to be determined, feedback channels need to be developed, and constant monitoring. Keep in mind the goal is to stay informed on everything that's happening. So communication to customers is key. Don't just, here's another thing, don't just sit and let your customers miss their invoice due dates without hearing from you. Giving people more time to pay, it is compassionate, but that action, that compassion needs to be on the back end of a meaningful discussion about what their world looks like right now. So talk to them about their world. Then if they need more time, that's what you talk about. Don't just give it to them on the front end. If you wait for them to contact you, it's going to automatically put you in a much less likely place to get paid. Because every day and every invoice that is late, there's more people stacking up in front of you. So I know, Jed, you were going to open this up for questions, but I'd like to share, I've been on the phone a lot the last couple of weeks, and I wanted to share just some common things that people seem to want to ask me. Is that okay, Jed, if I do that and throw it out there, what my advice was?
Please do.
Okay, so, you know, should we lower credit limits on customers that are slow paying? I would definitely look hard at credit limits. Those limits might have been set years ago. Product pricing is low right now. Do you really want a $10,000 credit line on a customer that's been buying $3,000 for the last couple of years? Look at your total AR exposure and what your AR balance is right now. If that exposure is a lot higher than your current AR balance, you've got some work to do on lowering those limits. I get asked, what do I do if customers are calling me, telling my credit people they just can't pay right now? Well, number one, bless them for calling you. That's a real positive thing. Now it's time to find out, back to what I said earlier, what can we negotiate? What can the customer do? But they're calling you, at least you don't have to spend the extreme time, energy, money to chase them. So that's a good thing. Getting asked, what about want to stop my EFT drafts? You know, you've got EFTs with dealers, which is standard operating procedure, but I know a lot of you have also been getting more EFTs set up on commercial business. If it's a dealer, this is a huge red flag. Treat it with top priority to learn why they want to delay that draft. If it's a commercial customer, yeah, it's a red flag too, but unless you have some sort of contractual agreement, I mean, you really don't have a choice. But again, find out what their situation is and what you can work out going forward if you're not going to be able to draft their account for what they owe you. So another question I've had, and this will be my last one, but what is the best way to escalate payment if a customer is not following through on promises? You know, do I want to use collection agencies, things like that? I don't really believe the current climate is right now for handing off you know, to a collection agency right after somebody is, you know, not paying you. You know, cutting them off, yeah, but bringing in attorney or collection agency, I don't know that I would do that in the real, you know, future. I go back to trying to find out what's going on and how you might do a workout situation. I know a lot of guys are saying, hey, we're, yes?
Finish that thought, Ann.
Well, I was just going to say, I hear guys that are saying, hey, we're waiving finance charges right now. That's a way to kind of lead with compassion. So, yeah, so do you want to ask me something, Jed?
Yeah, and you mentioned EFT, and like a lot of commercial accounts, people haven't gotten on EFT, or agricultural accounts before, they got longer terms. Getting them on the EFT obviously would be fruitful in this time period. Is there any way, and maybe Howell or Jeff can weigh in on what you've done, but to encourage them to move on to EFT, which would take some of that risk away from us, possibly a slight discount?
I hear about discounts. I hear about maybe a little more of an extended term. What's in it for them? You know, for them to go on EFT, offer them a discount for a period of time, offer them, a few extra days to pay. Maybe they need a favor from you, and in return, you're going to ask that they sign up for your Easy Pay program, go on EFT. Hal, do you guys have any great ideas on that?
In the past, that's what we've done. We've really been pushing to get people on the EFTs, and that's exactly what we've done. We've either offered a discounted margin for a period of time, trying to extend terms because that kind of gets my money tied up. And these times, that may be something that we consider. But the quid pro quo is that they got to get something too, like you said. So for a period, if I can get them on EFT for a reduced margin for 30 days or 60 days or something like that, and keep them on EFT, then I think that puts my cash flow in a better position.
Right.
Jed, if I may, this is Jeff.
Oh, go ahead, Jeff.
What I was thinking to follow on to that is right now in this period of the pandemic, people are very wary about touching things and opening mail and stuff like that. We only have 2 to 3 of our commercial fuel accounts that are not on EFT because of the work that Howell's done with his groups to get all of them on EFT for those various ideas that you shared. But right now is a good time to start suggesting that and just saying, hey, you can reduce the amount of paperwork that you're handling if you allow us to go EFT. It's just another way of thinking about it during the current situation.
Great point. That's a really great point. Yeah. So Jed, I'm just finishing up. Let's just be smart, forward thinking, dealing with what we have today and planning for the financial health of our companies in the near future. And we'll get through this and be better off and lessons learned for it. And if anybody has any specifics or questions, they can always reach out to me. So that's it.
Sounds great. Thank you so much, Ann, for those quick hits. And one of the things we have talked about is credit insurance as being a way to reduce some of your AR risk. It can come in handy now as the risk profile may have shifted. Hal, if I heard you right, you guys use for some of your accounts credit insurance. I know some other study group members do as well. So Corey, we'll turn to you, Corey Watson, and just give us a high level of what credit insurance is, and then more importantly, talk to us about the trends that are taking place in credit insurance market. Can I still get credit insurance? Are they retracting the money from this industry or industries at large because of the exposure, et cetera? So, Corey, I'll turn it to you.
Yeah, we'll do. Thanks, Jed. Hal and Jeff, I got to tell you, what you guys are doing is impressive. So it's good to hear, your strategies for getting over this. But I'll touch just briefly. A lot of you may know what credit insurance is, but if you don't, it's an insurance policy that you purchase that guarantees that your receivables are paid. So if you invoice a customer and they don't pay that bill, whenever you deem it to be uncollectible, you could file a claim. The insurance company would pay you after a brief collection period to try to collect it for whatever's owed up to the credit limit that you have on that customer. That would cover a general non-payment. A customer doesn't want to pay or he can't pay, or any type of bankruptcy, whether that's formal or informal. That's sort of the concept behind it. I get asked this question a bunch in the fuel world is do I have to insure every customer? I was told I have to insure my whole portfolio of customers. So the answer is no to that. If you have a company, let's say you're selling to Amazon, so you can exclude that company from the policy along with prepaid sales, credit card sales, intercompany sales, governmental sales. You just kind of need to put together a logical segmentation of accounts, and then we can write a policy. That's how you would write a policy. There's many other advantages besides just general risk. I know with COVID-19, everyone's looking at credit insurance from a risk perspective, but I want to mention that there are a few other benefits to credit insurance as well. A big piece of that, and Jeff touched on this earlier, is bank financing. So a lot of companies, they will purchase credit insurance to leverage it with their borrowing base. So if you have any sort of concentrations, the banks will typically exclude that from borrowing. So with credit insurance, you can insure that risk, and it puts it back in the borrowing base. They'll also give you a higher advance rate. Banks will look at, a lot of my clients have 90% advance rates because the bank likes the add-on of the credit insurance to allow that. As you renew your credit lines as well, you can leverage the credit insurance to negotiate rate. So if you're going to buy it anyways for risk, you might as well get all the benefits out of it from the bank side. I'm sure there's a big exporting piece here. Not a lot of companies here probably exporting, and you can free up letters of credit. So there's a whole bank finance tie to credit insurance. Another feature is support credit. So today you have credit and collections, but you don't have any knowledge of your customer's customer in regards to whether they're going to pay their bill. So a lot of companies look at credit and they'll say, as long as I'm being paid on time, then I don't have a reason to go back and get updated financial statements on that customer. But the credit insurance companies, they look at credit as a whole, and they're going to say, well, you may have $100,000 in credit on this one company, but the carrier may have 2 or 3 million of exposure on that company. So it's in their best interest to monitor that customer throughout the year. And then the last piece, I would say, credit insurance is really good for salespeople. So if you have certain customers that maybe you're unwilling to sell to because they want a higher credit limit or they want longer terms, and you're unwilling to do that, and you require prepayment or personal guarantee, and they're balking at that, then leveraging credit insurance is a really good tactic to that. If you could buy a policy and you could insure that risk, could you sell more to that customer? One of the last pieces Ann touched on too is collections. So a lot of companies will buy credit insurance as leverage. So they'll call a customer and they'll try to collect. And then if they get too far past due with credit insurance, you can call that customer up and say, I've been working with you and I want to try to help you because there's a trigger in this insurance policy that I have that says if I don't report this to my insurance company, if you're not paid by this certain date, then I have to file a claim. And if I file a claim, then I'm going to have prepayment from here forward. So it's sort of leveraging this big, bad, ugly insurance company to help you collect on receivables.
So Corey, that's the big picture on what credit insurance is, and it looks like you've got a little bullet point there on the cost as well, which is fractions of cents. The big question is, can you still get credit insurance these days, or is the money retracting?
Yeah, I should have put pre-COVID and then post-COVID on this, but I'll tell you, over the last 10 to 12 years, we've looked at credit insurance, and it's been a third of a penny to about a half a penny per gallon. That's been the going rate for fuel distributors. Today, you absolutely can get credit insurance, but it's sort of like, I was told it's kind of like face math, where the demand is really high right now, but the supply is limited. So you can get it, but you're either going to pay more for it, or there's not enough coverage to go around. So the carriers are looking at this and they're saying, from a global exposure, we're only willing to insure this company for $7 million globally. They don't care who has the coverage. That's the most they're willing to put on this particular company. So once that $7 million is gone, then you're not going to be able to get that coverage. So it's sort of the coverage is available, but it's just harder to get. But you can definitely get it.
Mm-hmm. And our industry in particular, I would assume if I was a credit insurance company, I would target certain industries and be retracting from them and going deeper into other industries. Our industry, petroleum, convenience, are they readily lending to this industry?
They are. The worst of it, I just blanketly say oil and gas is upstream. Any drilling or that type of space it's virtually impossible to get credit insurance worth purchasing, because the cost of the policy wouldn't be worth it for the minimal amount of coverage you're going to get. But in this space, it's better because they like the terms are short. There's still a demand, right? But the losses are relatively low. And then for some businesses, they can be smaller because the terms are short. You don't have 60 or 90 days worth of AR to build up before a claim comes in. So.
Yeah, so still lending, but maybe a little tighter than what they were, and it's a little bit more expensive than what it used to be. And if you currently have credit insurance, are people looking at the accounts that historically they've insured against and starting to pull credit insurance from certain accounts?
Yeah, so I can give you an example from one of the carriers. They would risk score a company. One would be best, 10 would be bankrupt. And about a year ago, they started to look at their global exposure and come off all the risk grade 8 buyers, let's say, right? So they reduced their exposure a while back. But now, just in the past month, they've come in and said, we're gonna reduce all the exposure on risk grade 7 buyers in a blanket, right? So they're coming off their riskiest customers, and those customers where they were more willing to approve to sort of stretch on a credit limit, they're saying we can do that, but we need financial transparency on that customer. So in the past, you may not have asked your customer for financials, but now they're requiring that to get comfortable with a risk grade 7 buyer or a 6. So they're going to want more information from your customers. They're going to want to see maybe your customers' information, which we've seen on very large transactions. They're going to want to see payment history. So there's a few extra steps that the carriers are asking for now that 3 months ago they would have just approved. So it's a little extra work, but but we can do it. Plus they're looking at structuring the policy, because they're going to weigh how much premium are we getting in opposed to how much in claims we're going to have to pay out, and what have we paid out over the past 3 months. So claims are up super high with all the carriers. So they're looking at raising deductibles and increasing a co-insurance on a policy that says, if I lose $100,000, then a typical fuel policy would have paid out 95%, and now they're, I've seen co-insurances up to almost 30% in some cases. So you'd have to look at how it's structured and how, and what the coverage is versus what you're paying.
And Howell and Jeff, I heard you guys say that you used credit insurance. How much do you do, and what have you seen? I mean, in terms of your own market, has it been helpful during this time to be able to have it?
Yes, it is helpful to have it, and it does allow us to get some customers that we may not have the appetite for the risk for. And the idea of saying, hey, if you don't get this current, I've got to report it is a very good collection tool, because they know that once it goes in, that it stays there. We are seeing, as described, that some, I think 3 of ours that we currently have credit insurance on, we've been given 30-day notification that they're coming off. And on at least one customer, the credit limit was lowered. So we're seeing, whatever you want to call that, a firming up or a tightening up of the credit that the people are willing to cover and the amount they're willing to cover.
Mm-hmm.
And Jed, they're going to see more of that. Sorry, go ahead. Yeah, that's it. That's it. I mean,
and then we'll wrap up.
Yeah, I was saying you're going to see more of that. So it's going to take Hal. I'd recommend for you guys to well, I won't get into that. There's some strategies to sort of they want transparency. That's really what these carriers want to maintain that cover. So.
Yeah, and one comment that came in from the audience member just says the strength of credit insurance may be that you now will sell a customer that did not pass your in-house credit test. And they just gave an example of roadway or yellow freight. So that kind of does help you sell to folks who you may not have otherwise sold to. And any closing comments, Jeff or Hal, from anything that Corey said or Ann said that sparked a thought in you that would be helpful for the audience?
No, not from me.
Jed, just to closing thoughts, we do use the credit insurance. We did it mainly for the exposure that we felt better at night on these accounts, and that was the main reason we got into it. What Hal said about 2 years ago, when we started using that, and it really just helped us feel better about it, and knowing that they were an extension of our credit analysis. Corey, I think your comment is exactly accurate about we need to keep supplying them with information to increase the transparency, as we have been given notice that the market is hardening, and we should expect a rate increase at our next renewal.
Yeah, and Jeff, one thing to think about too is on the supply side, when these fuel prices do come back up, it's gonna shrink a lot of your suppliers' credit limits. So you could theoretically insure yourself with your supplier and get a larger limit. So it's sort of reverse credit insuring, but there's some strategy there you can use as well, or for companies in general.
Good point. Thank you.
And Ann, before we sign off here, any closing comments from you?
Well, I think I would just tell everybody to do what I think people are doing, and being very diligent and proactive on, keeping in touch with your customer base, and making sure they understand you're a business partner, you're there to help them.
Thank you guys very much, Hal, Jeff, Ann, and Corey. Really appreciate your candidness and willingness to give of your time here. I will send out, as I said, the contact information for Ann and Corey. I know if you have any questions, they would be happy to correspond or do what they can to make sure those questions are answered for you. Appreciate your time on the call. We'll be sending out the recording, and stay safe and healthy in the meantime. Goodbye, everybody.
Thanks.
Thanks, Ed.
Bye.